Hello, everyone. Welcome to this podcast from National Institute of Securities Markets, popularly known as NISM. NISM is SEBI's educational initiative. I am Kunj Bansal. Financial year 2022-23 ended a while ago. And in a year of not so high expectations, we have a pleasant news on India's growth story with a GDP growth rate number of 7.2%. Financial year 2023 was a challenging year, not only for Indian economy but for the world as a whole. The biggest challenge that economies world over faced was the inflation. Of course, India couldn't have remained immune to that. We saw how the inflation continued to rise in the financial year 23 and reached a peak. Thankfully, it started correcting towards the end of the financial year. As we can see in these slides, inflation, both on the wholesale basis as well as the consumer inflation number, reached a peak in 2023 and then started correcting towards the end of financial year 2023. Taking a signal from these, RBI, which had increased interest rates by 250 basis point from 4% to 6.5% in a short period of about 10 months, finally took a breather in its April Monetary Policy Committee meeting to put on hold any further rise. Another challenge that Indian economy faced was sky high crude oil prices. Let us recall that financial year 23 started in the backdrop of Russia-Ukraine war, resulting into sudden increase in commodity prices, including oil and metals. Subsequently, it did not sustain at the peak, it did come down, as we can see in this slide. Of course, India was able to save some money by importing Russian crude at discounted prices. The other challenge that we faced was the reduced export growth rates. Why did it happen? Because of the prevailing slowdown and recessionary conditions in almost all the major economic zones of the world. Indian economy also did not get the support of portfolio inflows. In the financial year 23, portfolio inflows, both debt and equity, remained volatile on a net basis, remaining negative for the financial year 23. The support came from domestic inflows, which were quite high, showing the interest of domestic investors, as we can see in this chart. The reduced export growth rate, negative portfolio flows, and other macroeconomic parameters did have an impact on the Indian currency. Indian equity market also could not remain aloof to these developments. Of course, not all was negative for the Indian economy. There were certainly positive developments as well. To talk about some such numbers, automobile sales for the financial year 23 was at a record high, as we can see in this slide. Banking credit growth was another positive, which remained at almost mid double digit growth during the financial year 23. Just to put it in context, this credit growth number was a mid single digit number in the earlier years. Yet another positive number was the sharp growth in the Mudra loans of the banking system. As we can see in this slide, Mudra loan growth was again at a record high. Higher economic activities resulted in GST collection continuing to go up, and GST collection were again at a record high during the year, ending the year also at a significantly high number compared to the earlier years. Housing sales in India was another positive development during the financial year 23. In FY23, housing sales increased by 50% to almost rupees 3.2 trillion compared to a sale of rupees 2.3 trillion in financial year 22. In volume terms, this growth was 36%. So this was the state of financial year 23. As we saw, there were certainly some negative developments, so were the positive developments also. It may be noted that the negatives were more to do with global economic conditions and not necessarily due to domestic factors. Now, where are we? Where do we go from here? How is financial year 24 likely to pan out? While it is always difficult to predict these things, but one can, of course, look at the numbers and try to draw some inference. We started by talking about inflation and how it started to come down towards the end of the financial year 23. Thankfully, that trend of inflation coming down has continued in April, and the retail inflation, as measured by CPI, came down to 4.7% in April 23. Even on the WPI, wholesale price inflation, the similar trend has continued. In fact, wholesale price inflation has gone into a negative territory. The number was at minus 0.92% for the month of April 23. Global inflows, which were negative, have turned positive in April and May. Amongst the other positive indicators in the start of financial year 24 is the RBI survey, which it carries out periodically. Participants in its survey are expecting optimistic scenario for financial year 24. In fact, they are expecting a positive demand growth, especially in the services and infrastructure sector. Although the same optimism is not shared as much yet for the manufacturing sector. Let's also look at what the World Bank has to say about the Indian economy. It says India's growth continues to be resilient despite some signs of moderation in growth. World Bank expects India's GDP growth for FY24 to be 6.3%. It's not prudent to interpret or conclude from the initial numbers of the financial year 24 in terms of inflation, interest rates, RBI survey, World Bank projection, etc. But of course, if we analyze, let us look at some of the areas where the headwinds to Indian growth can come from. One area is return of global supply chain shocks. In addition to global supply chain shocks, the other negative could come from fresh increase in the commodity prices. Although global commodity prices, specifically metal prices, have been on a downtrend, but if the trend changes, that could be another negative for Indian economy. Yet another negative could be the continued consumption slowdown that is there in the economy. Where can the positives come from? Where can the Indian economy have the support of tailwind? One, we have seen that how inflation has started to come down. Assuming that the inflationary downtrend continues, that will be a big relief for the Indian consumption demand. Secondly, which will be an outcome of inflation downtrend, the interest rates are likely to have peaked out. In fact, the 10-year government security rate has already started to trade below 7%. So that is another relief for the Indian economy. If we mix these two things, the inflation downtrend and the interest rate topping out, we can see the consumption demand coming back to economy, and that will be a big boost to the growth. Of course, a normal monsoon will aid in the overall sentiment towards the positivity, and we can see the rural consumption demand coming back. On a longer term basis, the most significant positive impact on the economy will come from the multiplier effect of continuous capital investments made by private as well as public sector in infrastructure areas such as rail, road, and sea. It is in the backdrop of these multiple factors that we have started our journey into financial year 2024. Let us see how it pans out. The expected GDP growth rate of 6% for financial year 24, although will be lower than the growth rate of financial year 23, which is expected around 7%. Let's keep in mind that this 6% number will be the highest GDP growth rate in the world amongst the similar sized or bigger economies of the world. While the intermittent positives and negatives will keep giving volatility to the overall growth rate. Given the positive surprise in GDP growth number of FY23, it might be possible that currently expected 6% GDP number for FY24 might also get revised upwards. And with this kind of growth, India is still well set on its growth path. This brings me to the end of today's podcast. Hope you enjoyed it. Thank you for your patience and thank you for listening. Please do share your feedback on the email provided in the attached slide. You can, of course, get in touch with us at our various social media handles. Look forward to seeing you in the next podcast. Till then, stay tuned. Thank you very much.